Welcome to the Fintech 2023 End of Year Wrap-Up. This year we've donated to the National Breast Cancer Foundation on your behalf instead of sending out Christmas cards. So I want to give you a wrap-up of what we've seen happen in 2023, what we think is going to unfold and what dynamic we're dealing with in 2024, and how that will translate back to your financial situation and the advice and strategy areas that we deal with for you to your financial benefit. If you remember, we have 6 areas of advice that we always refer back to. And it is important because we need to consider what stage you're at in life, which of those financial advice areas and the strategies will apply to you. Things like government regulatory change. The Labor government have actually proposed a new tax for individuals with super balances of more than $3 million, potentially a little bit more tax. That will come in the 2025 financial year if it gets through all of the mechanisms of the House of Representatives and the Parliament. So, moving into the economy, there's been quite a resilient outcome this year in terms of the economy. And some of that's to do with inflation staying quite high. So last year I spoke a lot about inflation. It really has been the big word. A lot of that is sticking, and when we look at inflation and we hear about it, there's different types of inflation. There's goods inflation and services inflation. There's headline inflation and core inflation. So one of the problems we've got is that we've moved away from goods inflation, which is still there, but now it's becoming embedded a little bit more in our services, which means when we start paying more for things that are services, they usually stay and they're much stickier and harder to get out of the inflationary growth that's occurring. So the Reserve Bank has moved to ratchet up interest rates quite quickly this year. In fact, it's the quickest interest rate increases we've had in the history of Australia. And that was on the back of the COVID pandemic, of course, and the stimulus that occurred to keep things moving along smoothly for the economy. So now we're in a position where that's benefited equities. Funnily enough, it actually has meant that bonds or defensive assets have stayed quite stable and steady, because when the markets look ahead, they'd already factored in that interest rates were likely to go up, but at some point come back down. So what's happening now is there's a bit of a Santa rally. I'd actually like to refer to this as a reindeer rally, because it's not quite big enough for a Santa rally. But if you look at the charts that I'm bringing up now on this video, the first one is of the ASX 200. So for the last year, you can see that there's a 4.88% increase. Very modest, quite flat, and you can see there was a period of upmarket and then sideways and a bit of volatility there. There has been an increase since October into November. In fact, October was quite a poor month, but now we've had, in the last month or so, a bit of a reindeer rally. Now, if I flick across to the US, you can see they've had a significantly higher growth than we have in Australia. They're up over 23% in their annual return. A lot of that has to do with the Magnificent Seven. And what I mean by that is the top tech companies that actually are the 7 biggest companies in the S&P 500 index. And they make up 25% of that index. So they're companies that you have heard of: Google, Apple, Netflix, Tesla is in there now, Microsoft, etc. So these companies have continued to outperform, and in some ways AI, artificial intelligence, is driving a lot of momentum behind them. And one of the things that's making that occur is the expectation that interest rates will start to come down if the economy is going into a bit of a recessionary phase or it's slowing down. The market has in fact moved that way. We're keeping our eye on that for you because we think that's a little bit getting ahead of the game, and if anything, equities are a little bit overpriced, and they are significantly in the US. Other parts of the world and in different sectors there are opportunities, and we look to take advantage of those for you. So talking about investments and markets, one of the things I do talk to you about often is growth assets versus defensive assets. So growth assets are things like shares or equities and property. Defensive assets are things like bonds, fixed income, term deposits, or cash in the bank. So what we've actually had happen in the last 6 to 12 months is interest rates have gone up so quickly that now you can get that 4 to 5% or even over 5% for term deposits that we're getting for clients. So, and putting cash in the bank for yourself. So that actually means you can get a 5% rough return risk-free. It's at the risk of the bank you put it in, but it's considered as risk-free. That compared to equities and shares that have actually had a surge in increase in price, which then when you look at the premium that you're paying for those equities, we think they're overbought and they're a little bit not as good value as we'd like to see. So you'll see that in your portfolios. There's a little bit of cash there that we've been waiting for buying opportunities. So one of the things that the market does is look ahead. And right now, this Santa rally that we've experienced, or I'm calling it the reindeer rally, it really has kind of jumped up quite quickly in that November-December period. And, you know, to some degree, there'll be some kind of settling. Now, it comes down to, and a big pivotal point is the inflation data in January. So on the 31st of January in the US and in Australia, we're going to see how the CPI figures are tracking and how that looks in comparison to the previous months and quarters. But it'll be for the quarter, for the December ending quarter. That'll be a big pivot point for the US Federal Reserve. They've been doing what's called jawboning. So they've actually spent the last year talking the market down and the expectation that rates will keep going up. But they just started to murmur that, well, we might drop rates if things look that way. And it's a bit of jawboning, as I said, and I wouldn't be surprised if they go back the other way early next year. But it'll all depend on the data, and then we'll see how that unfolds. The good thing is, though, we're positioned to take advantage of this for you, no matter which way it goes. So, as you're aware, we employ the best specialists, investment research houses, and people to look at what are the best companies, investments, sectors, and areas to invest in, and which ones are good value. And some of the investments at the moment, because of higher interest rates, are looking less attractive. So things, you know, some investments will do well as interest rates drop. So when the economy does move into a more recessionary phase, if it does get to that point, we'll then be able to take advantage of those companies. But in the meantime, we're being careful because we don't want to overpay for equities that potentially could have significant volatility in the short term. And we can get 4 or 5% from a coupon from a bond and with no risk on the downside. The benefit of bonds too, which is very significant right now, and you'll notice that you're invested in bonds across your portfolios, is that as interest rates do start to come down, because I think we have hit peak interest rates, it's just how long they'll stay where they are. If inflation data stays sticky, interest rates will stay where they are for some time, and it's all dependent on data and a few other things. But if interest rates do start to come down, that will actually benefit bonds. Not only are you receiving your 5%, 4.5% coupon, but you'll actually get an increase in the capital value. So that's one of the reasons we really like bonds at the moment, and we're holding our time for equities as those opportunities arise. There are lots of sectors that we can invest in, and we're utilising the best research to do that. So in summary, we've had a really great year. We feel privileged to be working with you and for you as your advisors, and we're committed to finding and determining the best financial strategies that will empower your financial future and the success that will enrich your lives. So from all of the team at Fintech, have a happy, healthy and relaxing Christmas, and see you in 2024. Thank you.